Let's chat about the markets a little further. We have with us Mahesh Nandurkar, Head of Research and MD at Jefferies, joining in on the show. Mahesh, hi. Morning. Hope all's well.
All's well so far. Trust the same with you and your viewers.
Yes, absolutely. Touch wood to that. Mahesh, I'm just looking at the way banks are performing today. Why is it that this is only a sporadic move that you see each time the global markets give a leg up? Banks as a cluster have underperformed, Mahesh. Do you think the NPAs and more importantly the unclarity that we have at this juncture on what the NPA picture is going to be like in its true form, that's the big overhang which is keeping banks at bay?
Yeah, that's true, Aisha. The NPL outlook and what kind of restructuring numbers will we come out with or will the banks come out with is definitely a big variable to keep in mind. The other variable to keep in mind, which is not getting talked a lot about, is also the margin outlook. Given where the spreads for the private banks are, which are significantly higher than their PSU counterparts. So I think these are the couple of things which are weighing at this point in time, in my view. And my sense is, a bullish view on the banking sector can be taken only once we know for sure that these NPLs are going to be much more contained. And I would say at a more broader level, we need to see beyond the immediate COVID-related recovery or opening-related recovery, what's the economic outlook, is going to be. I think we need clarity on these two fronts to take a substantially constructive call on the banking sector.
Sure. But Mahesh, as an investor, is this not the time to actually buy banks? Because you always buy the dip and sell the high then.
Yeah, true. So from a long-term investor, they can possibly, take this call. But I just feel that there are a few other pockets in the market which have also underperformed in the recent COVID-related market performance, and I would like to particularly bring out real estate developers as a class. I mean, I know it's a very small part of the market, but I think that can give substantially positive returns. So I would be much more positive on that. And I think in some way or the other, I feel that the banking sector recovery, the sentiments and the stock recovery will also be linked with how Indian property markets behave. Because, as I mentioned in the first part of my answer, I believe that we clearly need visibility on economic recovery beyond this COVID-related recovery. And I think that can come through, in my view, only if the property markets recover. That's a very large part of the economy, which has done quite badly over the last several years. And I think we are seeing some maybe very, very initial signs of that segment bottoming out. But unless we get a conclusive direction on that, I would wait, to turn constructively bullish on the banking and the lending space as of now.
Okay. So just to get it right, are you saying stay away from even the property names?
No. So property names, no, as I said, so if you're just looking at the laggards, which you mentioned, that banking sector is one of the laggards, I just wanted to highlight that, if you're looking at, which are the stocks of the sectors to pick up at this point in time, who have laggards, which stocks have been laggards, I would say property developers is the first name that will come to my mind, from a buying perspective. So in fact, that sector will be my top pick today.
Got that. Interesting dynamics, Mahesh, playing out within the auto segment as well. While it's now well known that the rural recovery has aided the growth for the likes of an Escorts, M&M, you are seeing dots of green building even for two-wheelers or, for that matter, passenger vehicles as well. We were just chatting with the Kia India Motors management as well. They're sounding just so upbeat. You think time is right to bet in on autos? And I'm talking the non-rural segment then, X of Escorts and M&M. And is a better way of playing the auto revival story via the ancillaries, the tire names, for instance?
Well, I would say that even the OEMs in the four-wheeler space look quite attractive within the auto space. And I would agree that some of the names which are linked to the rural recovery, especially the tractor segment, is not looking particularly attractive at this point in time, given the way it has had a run, and also the incremental positive news, in my view, is going to come more from the urban side and the discretionary consumption side. So the four-wheeler segment, appears to be better bet within the four-wheeler space, in my view. Also, I believe that there is, to my view, some kind of euphoria, or not euphoria, maybe some kind of positive expectations built around the rate cut, the GST rate cut on two-wheelers. To my mind, it is not that highly likely an event, and on the contrary, it can weigh down on the volumes, from the end user perspective. So four-wheeler definitely appears to be a better bet within autos.
Okay, fair enough. Is it still with the frontline names, Mahesh? I see a smattering or just a few in the broader markets. Are you still being incredibly selective? Even though your outlook is positive, are you still sticking to the safer frontline names?
So our view here is that the market view is definitely constructive. We believe that a combination of global liquidity, which is keeping the risk-free rates globally and also very much in India depressed, and in the context of these lower risk-free rates, which we think is sustainable, the market multiples and the stock multiple appear reasonable. That's one. And secondly, we are clearly seeing economic recovery shaping up nicely, responding well to the government moves on opening up, of the economy, and from the COVID-related restrictions earlier. Our proprietary Jefferies recovery tracker is indicating that the economy has now recovered to more than 93% of the pre-COVID levels. So these two factors make us constructive on the market outlook going forward. So within that, we are clearly taking a more pro-recovery stance. And therefore, the stocks and the sectors that we like, as I said, are more geared towards the recovery side. The only space within the recovery side where we are keeping on hold at this point in time is, as we discussed earlier, banking. But apart from that, real estate or cement or materials or consumer discretionary, including autos, are the ones which we favor at this point in time. And we would, in fact, be neutral to underweight on some of the so-called safe bets like the consumer staples and pharma.
Okay, and what about IT then? Let's talk about that. Where does that fit on your radar?
So we have been, quite positive on IT, for some time, because as I said, it's the best way to play the global recovery. So, mind you, when we talk about recovery, there is a global recovery and then there is a domestic recovery. And the best way to play a global recovery, has been IT services, or one can say, the select metal names, or the global commodity names. And while we continue to have a positive view on IT services, given the way the stocks have moved over the last few months, and the valuations, is clearly getting to a level where the expectations are rising. In that context, I would say metals, could be a better space to look at to play the global recovery.
Mahesh, what's your view on the ever-contentious telecom sector? For Bharti Airtel, there has been the benefit of market consolidation, a rise in ARPUs. How are you playing this space?
Well, I won't be able to comment on stock specifics, details here, but, what I can say is that, the much awaited, pricing, the return of the pricing power for the sector seems to be getting delayed, a bit, and that has what has resulted in, the sector underperforming, of late over the last 1 or 2 months. My sense is that till the time we get the signs of pricing power coming back, it is not going to be an outperforming sector. So I will hold my horses on that one as well at this point in time.
Aisha flagged off, non-rural when it came to auto, but just going by the basis of the good monsoon and, working on the theme of the non-metros outperforming the urban areas, are there any other spaces that you would be confident in basis the rural theme?
Yeah, so as I said, the rural part of the economy did pretty well. It was the least impacted, during the COVID-related downturn, and the stock prices are, already reflecting, that strength in my view. So when you talk about, the rural plays, it's basically people, it's like staples or two-wheelers or tractor names. And those are the names, I'm still going to, as I said, keep a neutral to negative view. Maybe there could be some niche plays like some of the pipes, the pipe related, sectors or stocks, agri pipes or whatever. So maybe those are, but those are smaller part of the segments. So, at this point in time, clearly my focus is more on the recovery. Which we feel, is going to be, urban driven, which is going to be driven by the property sector, in my view. So therefore, our top picks and at the sector level, the stock level is more geared towards the potential property market recovery and the allied sectors.
Mahesh, why is it that you're underweight on staples?
Well, as I said, so we are clearly more constructive, on the recovery side. So, staples is a sector which, hasn't really, had, a downtime or a downturn as such, as I said, even during the COVID period as well. And that has been a sector where, which has been like a favorite, hiding place for many investors because there was lack of growth, lack of visibility in the other segments of the market. And, therefore the valuations, on that segment, on the staple side, went up, quite materially. But we are, as I said, taking a more positive stance on the economic recovery, which is, and also the global recovery as such. So clearly, our overweight are, more on the recovery side. Staples is not a recovery play. And that's the reason why we are underweight.
Sure, makes sense. Mahesh, we've got a large event, or rather big event ahead of us, the US presidential elections. Now, I know that global markets only worry about the $2.2 trillion stimulus package, and that's what they're awaiting. But given that it's going to be a big event and a 50-50, chance of a Democrat or a Republican win, how do you think you need to tactically position yourselves for the event, whichever party may win, either be the case?
Well, yeah, as you rightly said, it's difficult to take a call, on political, outcomes, especially in the US when the contest is, so close. And I think what the market will, really like is, some kind of balancing of power. Rather than concentration of power. So, if we, like, just for the sake of argument, get a Democratic, president, then the markets would like to see, some kind of a strength, for Republicans, in the Congress, or the other way around. So what, my belief is that the market, the global markets, and therefore also, India, to an extent is globally linked. The Indian market also, would like, in my view, is the splitting, of power between Democrats and Republicans. And if it, just goes one way, whether it is Republicans or Democrats, that's, is not likely to be a very positive, outcome in my view. So yeah, I mean, all that we can do is, sort of, wait and watch how those, developments unfold. But having said that, I will still say that, going into, calendar 21, the outlook for, US recovery still remains optimistic, whether it's a Republican president or Democratic sort of president. And, we continue to believe that the US government will be taking a loose fiscal stance. Also, the Fed, which has already been a big supplier of global liquidity over the last 6 months, will continue to be that way. So whichever way it goes, we still believe that economically speaking, the outlook should still be positive. Yes, I mean, there are some tax-related issues which, the parties have spoken about, and, we can see those tax-related changes impacting, certain stocks and certain sectors in the US, and, maybe that has a negative impact, on the rest of the world, basically on the tech side. But outside of that, I would still remain constructive on the economic recovery in the US and therefore the global recovery as well. Whichever way it goes. But as I said, the ideal situation will be the split of power.
Mahesh, we were just chatting with Rakesh Jhunjhunwala and trying to dig out as to at what stage of the rally we're at. And given that he's a foodie and he likes to wine and dine out, he said that we're not even at appetizers. We're just doing pre-dinner drinks. Then come appetizers, the main course, the dessert, then the brandy and the cigars. I'm not going to talk about such a long-term view, but purely on a fiscal year basis, Mahesh, would you believe that on a PE basis, have we already played out the best for the markets?
No, so as I said, PE basis, on the headline basis appears to be expensive, but actually it is not. If you compare with the much lower risk-free rates that we are looking at, and my favorite valuation indicator here is earnings yield minus bond yield. So the market being at like 20 times 1 year forward, the earnings yield is 1/20, which is like 5%. And if you look at the 10-year GSEC rate, that's at 6%. So the gap between the two is 1 percentage point. And if you look at the last 10-year average, it's been like, it has gone up, it has come down, but by and large, the average is at about 1 percentage point. So from the valuation perspective, we are not really stretched. If you put it in the context of where the risk-free rate is. And in fact, one can take a much more constructive view, if one takes a view that it's not the 10-year, but maybe it's like the 5-year or a 3-year or something like that is the better reflection of risk-free. Then one can justify further re-rating as well. So conclusion is that the P multiples or the valuation is not really out of the whack in my view. And so therefore, the market returns from here on, should be in line with what the earnings will behave. I mean, obviously, this year is going to be a bad one, and the next year will be, a very good year, on the base of, on the low base of FY21. And we are looking at almost like a 40%, 35 to 40% kind of an earnings growth for Nifty in FY22 on the low base of FY21. So long as those expectations, stay on course, and my sense is, it will. Although we have seen many a time in the past that the earnings expectations have been revised downwards. So to answer your question, if you look at the fiscal year outlook, the next 6 months, I would still be, on the optimistic camp. Not as much optimistic as your previous interviewee, but yeah, definitely on the positive side. And I believe that from a 12-month perspective, the market should easily deliver a double-digit return.
Good to hear that. Mahesh, I see a lot of books behind you. Any recommendations for our viewers? Any interesting reads?
Well, that's my dream, that I would go through all these books, and maybe when we chat the next time, I'll come up with some recommendations.
Okay, do that. Good to have you, Mahesh. Thanks as always for taking time out.
Thanks a lot. Bye bye.